We're turning our focus now on latest developments of the foreign exchange market. Now on Wednesday, the Central Bank of Nigeria announced the closure of the RDAS, that's the Retail Dutch Auction System, and it said it was to avert the emergence of a multiple exchange regime and preserve the country's foreign exchange reserves, which as at yesterday had dropped to as low as dropped to the $32 billion region. Well, to talk more about this, I'm being joined on the program by two research analysts from Financial Derivatives Company Limited, Damlola Akimbami and Dr. Emmanuel Olowokere. Good morning, and thank you so much for joining me on the program.
Good morning.
So, is this the first time the central bank has had to take this kind of measure, and did it even come as a surprise to the market? Dr. Olowokere, let me start with you.
In the history of exchange rate management in Nigeria, the central bank has always done a lot of things. This is not the first time that IFM has been introduced. It was introduced in 1989. Also, it was introduced in 1999.
That's the interbank foreign exchange
market. So it has always been around. And the last time we switched from it to DAS, and before then, in the 1989, we switched from it to another exchange rate system. So we have always been having one change or the other in our exchange rate management. So it's not the first time we have seen this.
But at this time, did it come as a surprise? Because, you know, there's so many issues that the central bank has had to deal with, you know, in terms of the fact that we had a polity that's already on edge because of the adjustment in election date. So, Damlola, did this come as a surprise?
Well, I would say it didn't necessarily come as a surprise because the markets have been suggesting or recommending a scrap of the orders so that there will be a convergence of rates. And what the CBN has literally done, it has reduced the structure from a three structure to a two-level one. So initially we had the CBN, we had the interbanks, we had the parallel markets. Now we have two players, well, we have many sellers. Now we have the interbank and we have the parallel market. So you've moved from a price discriminating monopoly where you had the same product but selling at different prices. You had 168 at the official market, you had about 199, 200 at interbank, you had like 215 at the parallel market. But now with what they've done by removing the orders, you have many sellers. So now you would see competition occur because all the banks will be coming up with different rates, but that spread, you're not going to have a bank selling at 200, another one selling at 250. So that competition is going to create a unification of rates, so you see rates coming together or converging.
When you say the unification of rates, would this be like we're seeing higher demand or higher pricing for the Naira? Because we know that the central bank's band rate is 168, or has this also moved with this particular this particular policy?
What you're going to see now, the dollar definitely is going to become more expensive, and we might actually see I'll use the word depreciation, whether like 2-3% depreciation in the currency. And the CBN is still going to be intervening at the interbank market. So we're not going to see 168 rates anymore. If at all, maybe the CBN might be intervening at maybe 188, 200. But the dollar is definitely going to become more expensive. And in the long run, because now that rates have converged or come closer, at the long run, you see that the BDCs might be removed at the end of the day. So that excess, because dollars become more expensive, that's going to push the demand down.
And that will mean that the Naira will now become properly priced.
Yes. Your Naira becomes more properly priced. It starts to trade around its fair value, and that will reduce the speculation and the arbitrary trading, which was what caused that spread before. So because you don't have an RDAS, you don't have that wide spread of 168 to 200, you now have everything trading around maybe 200, 215, 220. So that reduces the incentive to arbitrage or to speculate. So it reduces the pressure and the certainty. And that's what we expect to see happen.
You mentioned the fact that the BDCs will probably be cut out.
In the long run, yeah.
Dr. Olowokere, what does this now mean? What's the implication of having the BDCs totally cut out from the system?
The BDC more like does the informal side of the market mainly. And when we say cut out, that doesn't mean that you have it eradicated.
But they'll be reduced?
They will probably be reduced, right, in terms of what they do. And what you really look at is what's the spread between the BDC and the official market or in the interbank. That's the main issue. At the end of the day, you are going to have something that is going to be very thin. Currently, you have about 45 Naira difference. So, I mean, the incentive is there. I can buy at the official rate. Instead of importing the commodity for which I got the money, I can sell at the BDC. I make more money. The BDC also make more money. But now, at this rate, the rates at the interbank will now be closer to the rates at the BDC. So there's no much incentive to go into the BDC like that, and then if I thought you are going to have any activity there, it's going to be marginal, not as much as you currently have.
But then could the CBN have looked at another option instead of closing the RDAS?
There are quite a number of options you can look at, but if you have a monopolist who sells in one market at 168, and then in another market you have things around 190, in another market 210, I mean, round tripping is always there. So currently, given the situation that we have, prices of oil have come down, the central bank doesn't have as much money as it used to have. I think the best now is to do what the central bank did.
But let's look at the system-wide impact. How much of this, closure is actually going to have an impact on the system? Damilola.
Okay, I would break it down into the impact on the government, individuals, and corporates.
Okay.
If you start with the government, they would have the government both on the state level and federal government would have more revenue in the sense that now you're multiplying what comes in by a higher figure. So instead of multiplying by 168, you're multiplying by 200 or whatever the rate is going to be. So there's more naira or more revenue for the government. And then for the individual, now even if you have more naira, the value that naira can purchase, the value of the naira reduces. So the goods you were purchasing before at maybe 168, you have to spend more to purchase that same item. So literally your disposable income reduces as an individual. And then also there's the inflationary aspect of it, because now if you devalue your currency, your exports are cheaper, while your imports are more expensive. And Nigeria is an import-dependent country.
We always have to remember
exactly.
that.
So that means what is coming in is going to be more expensive, and that obviously would translate into the cost of things, goods and services that we purchase in Nigeria. So then you are paying for more. So that inflationary aspect also is going to affect the consumer. And now for the corporates, like I mentioned, in terms of imports, most of their inputs are imported from outside. So obviously you have three options. Is either you fully absorb the cost, the increase in cost of your inputs as a corporate, which you're not going to do because you're in that business to make profit. Is either you transfer everything to your consumer, which you can't really do because their absorptive capacity has reduced because they have a lower disposable income. So the only other option is either to break the cost. So you bear some and your consumer bears some. And also there's going to be an issue of a minimum wage increase because you have to compensate your employees, you have to compensate the consumers because now they have a lower disposable income. So that we see happening. So in essence, all this that have happened, we would say that it's like a means towards what we call full convertibility. So you start by removing your orders, you start by creating efficiency in your forex market, you start by allowing your goods being traded easily. Like we have the common external tariff, which has allowed to an extent for a free passage of goods within the ECOWAS region. And then these are some of the steps that need to be put in place before your currency can become fully convertible.
Back to the fact that we're more import dependent than export. Now that this situation is staring us in the face, a lot of operators have been asked to take this opportunity and beef up their capacity in terms of what they can export. But we still do not see that happening. And so it now seems as if this measure came too quickly, although a lot of people saw it coming, but it came too quickly, too suddenly, for them to even realize whether they had a sure footing in terms of, being more export-driven than import-driven. Dr. Oluwakere.
We'll probably have to look at something. Depreciation harms the importer, but it's also a benefit to the exporter. So there are winners and losers of depreciation.
But we shouldn't have any situation where we're having more losers than gainers. It should be a gain-gain situation.
So the problem in economy is all about trade-off. The major problem is that we have a lot of importers, and most firms are import-dependent, and they are net importers. So that's a big issue for Nigeria that has to be considered. Central bank is for monetary policy. There are other policies in the economy. You have the fiscal policy, you have trade policy, industrial policy. So a lot of things still have to be done in those areas. But the fact that you have not been able to do them in some aspect does not mean that the central bank cannot do its own, because you are going to have a lot of issues at the end of the day.